Disclaimer. Something is happening across the gold and silver markets right now that almost nobody is connecting the dots on. And if you miss it this weekend, you are going to be watching it in hindsight, wondering why you did not see it coming. Let's start with a number that the financial press treated as yesterday's headline and moved on from. Yesterday, Friday, April 10th, the Bureau of Labor Statistics released March 2026 CPI. Headline inflation came in at 3.3% year-over-year, the highest reading since May 2024, a 0.9% monthly surge, the steepest single-month jump since mid-2022. Wall Street had expected hot numbers. They still got surprised by how hot. Energy alone spiked 10.9% in a single month. Gasoline up over 21% from February to March. Now most viewers saw that headline and thought, inflation is bad for gold and silver. Higher inflation means the Fed stays frozen. No rate cuts. Non-yielding assets lose appeal. That is the surface read. That is the read that keeps most people watching the wrong movie. Here is the signal that the surface read misses completely. And here is why it matters to you right now, today, on Saturday, April 11th. Welcome to AG John OG, where we do not chase daily noise. We track the structural forces that actually move real wealth across economic cycles. If this is your first time here, subscribe right now and turn on every notification. What we are building on this channel is a community that reads these patterns before the crowd catches up, and the next few weeks in precious metals could be some of the most important in years. Do not be on the outside looking in. Now let's talk about the actual signal. Across the past 3 weeks, gold and silver have done something historically unusual. In the middle of a shooting war in the Middle East, with oil above $100, with inflation jumping to a 2-year high, with the Federal Reserve completely paralyzed on rate cuts, gold has managed to record 3 consecutive weekly gains, and silver has surged over 4% in a single week. Think about what that means. The conditions that are supposed to be the worst possible environment for precious metals, rising inflation expectations, rising interest rates, a stronger dollar as a competing safe haven asset, all of those conditions are present simultaneously right now, and gold closed Friday at approximately $4,749 per ounce. Silver held above $75. Both metals are gaining ground despite every traditional headwind being active. That is the signal. When an asset class refuses to go down in the environment that is designed to push it down, it is telling you something critical about the underlying structural demand holding it up. Now let's build the full picture, because the signal only makes sense when you understand the 3 layers underneath it. Layer 1 is the stagflation data. This is the one that most people are only beginning to absorb, and its implications for gold and silver are historically enormous. Yesterday's CPI print of 3.3% came on top of a Q4 2025 GDP reading of just 0.5%. Let that combination sit with you for a moment. 3.3% inflation, 0.5% economic growth. That is not a booming economy with inflationary pressure. That is stagflation, the economic condition that is simultaneously the hardest for central banks to manage and the most powerful historical environment for precious metals. The last time the United States experienced genuine stagflation was the 1970s. During that period, gold rose from $35 per ounce to $850, a gain of over 2,000%. Silver went from $1.50 to nearly $50. These were not temporary spikes. They were structural repricing events that lasted nearly a decade, because stagflation traps central banks in exactly the position the Federal Reserve is in right now. Raise rates to fight inflation, and you risk killing an economy that is already growing at only 0.5%. Cut rates to support growth, and you risk sending inflation from 3.3% back toward 5 or 6. There is no clean exit, and in that policy paralysis, gold and silver historically become the asset class that serious institutional money treats as the only real store of value. The March 2026 data has now handed the market the first hard confirmation that the stagflation scenario is not just a theoretical risk, it is the current operating environment. And gold is already responding. Layer 2 is the gold-silver ratio, and this is where the truly important signal lives for investors who understand how to read it. Right now, as of this weekend, gold is trading at approximately $4,750 per ounce. Silver is at roughly $75 to $76 per ounce. That puts the gold-to-silver ratio at approximately 63 to 1, meaning it takes about 63 ounces of silver to buy a single ounce of gold. Now here is why that number matters. In late 2024 and early 2025, this ratio hit above 100 to 1, an extreme reading that historically has always resolved with silver dramatically outperforming gold in the subsequent period. And it did. Silver surged over 147% in 2025, more than doubling gold's already extraordinary 67% gain. The ratio compressed all the way down toward 57-1 by early 2026. Then the Iran war started on February 28, and the ratio expanded again as silver sold off harder than gold during the conflict, because silver's industrial demand component made it more sensitive to fears of a global economic slowdown driven by $112 oil. Silver fell nearly 20% from its January peak near $121 per ounce all the way back to the mid-70s. Gold fell too, but far less sharply because gold's monetary safe haven demand cushioned the drop. So right now, in April 2026, the gold-silver ratio sits at approximately 63-1, which is historically elevated compared to the long-term average that many analysts place closer to 45-50. That elevated ratio is telling investors something that has a consistent historical track record. Silver is statistically cheap relative to gold at this level. Every time this ratio has compressed from these levels in the past several decades, silver has outperformed gold on the recovery. Not by a few percentage points, by multiples. Bank of America's precious metals analyst Michael Widmer has maintained a silver price target range of $135 to $309 per ounce for 2026, based specifically on the thesis that the gold-silver ratio will compress from current levels. That is not a fringe forecast. That is a major institutional research team at one of the world's largest banks putting their name on the structural silver thesis. Layer 3 is the upcoming week's economic calendar, and this is what makes right now, this specific weekend, such a critical inflection point for both metals. Markets are closed today and Sunday. When they reopen Monday, the clock is ticking on 3 events next week that will collectively determine whether gold and silver can build on this week's recovery or face fresh headwinds. Tuesday, April 14th is the release of the March Producer Price Index data. The PPI measures inflation at the wholesale level before it filters through to consumers. Given what the CPI confirmed yesterday, a hot PPI reading would compound the stagflation signal and tell the Fed that price pressures are embedded across the supply chain, not just in consumer-facing energy costs. A cool PPI, particularly in core categories, would give markets the signal that energy-driven inflation is not spreading into broader price structures, which would revive Fed rate cut expectations and be powerfully bullish for silver and gold. Wednesday, April 15th, the Federal Reserve releases its Beige book, the anecdotal survey of economic conditions across all 12 Fed districts. This is not a policy decision, but it is one of the most revealing documents the Fed publishes because it captures what is actually happening in the real economy across every region of the country. If the Beige book confirms what the GDP number already suggested, that growth is stalling while costs are rising, the stagflation narrative becomes the dominant institutional framework for pricing precious metals for the rest of 2026. And in that framework, the historical data is unambiguous. Gold and silver both perform, but silver, with its compressed ratio and its structural supply deficit, performs better. And then there is the Islamabad wildcard. Right now, as you watch this video on Saturday, April 11th, U.S. and Iranian delegations led by Vice President J.D. Vance and Iran's parliament speaker are sitting across a table in Islamabad, Pakistan, negotiating a potential framework for ending the Iran war that began on February 28. Those talks began this weekend under the fragile cover of a 2-week ceasefire that is already under strain. If the Islamabad talks produce real progress, oil prices will fall further, energy inflation in the April CPI will be lower, the Fed will have cover to consider rate cuts later in the year, and silver, which has already demonstrated a 4% weekly surge when geopolitical tension even begins to ease, will be positioned for an explosive recovery that closes the gap between its current price and the structural value that 5 consecutive years of supply deficit has been building. If the talks collapse and the war re-escalates, oil surges back above $112. Inflation expectations explode higher, the Fed gets pushed even further from rate cuts, and in that environment, the stagflation trade intensifies. Gold holds better than most assets, silver gets short-term pressure, but the structural story does not change. Both paths lead to the same conclusion. Gold and silver are the assets most directly levered to the primary macro forces driving markets in 2026, regardless of which direction the next event shock comes from. Now let's be honest about what the risks look like from here, because this channel earns its credibility by telling you the full picture, not just the part that confirms what you want to hear. The most significant near-term risk for silver is a stronger than expected PPI reading next Tuesday that, combined with yesterday's CPI, forces the market to price in the possibility that the Federal Reserve could actually raise rates rather than cut them. Oxford Economics has already warned that the April CPI reading will be, in their words, uncomfortably strong. If the April data compounds what March confirmed, the rate hike scenario becomes a real market conversation, and silver in a rate hike environment faces significant pressure from a stronger dollar and higher opportunity cost. The second risk is geopolitical re-escalation. The Islamabad ceasefire is fragile. Israel's ongoing bombardment of Lebanon, which Iranian officials have explicitly called a deal-breaker, could unravel the entire diplomatic process this weekend. If that happens, the Iran war enters a more dangerous phase. Oil prices reverse their ceasefire relief rally, and silver's industrial demand outlook takes another hit. The third risk is specific to silver's extreme volatility. Silver hit an all-time high near $121 per ounce in January 2026. It then fell all the way to the mid-60s during the worst of the war and inflation fears. That is a 40% drawdown from peak to trough in under 3 months. Investors who are not psychologically and financially prepared for that kind of volatility should not be in silver at any price level, no matter how compelling the structural thesis looks. These are not hypothetical warnings. They are the documented behavior of this market over the past 90 days. But here is what the evidence keeps pointing back to, consistently across every layer of this analysis. The structural case for gold and silver in 2026 is not a short-term trade thesis. It is built on 5 consecutive years of silver supply deficit, 75% decline in COMEX registered inventory, China's export restrictions, relentless industrial demand from solar and AI infrastructure, and now the confirmation of the stagflation environment that historically produces the most powerful and sustained precious metals bull markets in modern financial history. These foundations do not change because of a bad week. They do not change because the Islamabad talks produce a mixed result. They deepen. Every week that passes without the supply deficit being resolved, every week that mine production fails to close the gap with industrial consumption, the structural tension in this market grows more acute. The signal that appeared this week across gold and silver is not that some chart line crossed or some oscillator triggered. It is that both metals are holding ground and building weekly gains in the exact environment that should be pushing them lower. That is not a coincidence. That is institutional money making a decision about where real value lives when inflation runs at 3.3% and the economy grows at 0.5%. You should be asking yourself right now whether you are positioned to benefit from what happens next, whatever form that takes. Not because anyone can guarantee what the Islamabad talks produce tonight, not because anyone knows exactly where PPI lands on Tuesday, but because the structural setup in gold and silver right now is the kind of setup that serious long-term investors who understand precious metals cycles recognize as rare and worth paying attention to carefully. Now here is what I need from you. This community is one of the sharpest watching these markets anywhere, and the next 2 weeks are going to produce developments that this channel will be covering in real time. What is your read on where gold and silver go from here? Are you watching the gold-silver ratio as your primary signal? Are you positioned in physical, in mining stocks, in ETFs, or are you still sitting on the sidelines waiting for more clarity? Drop your position and your reasoning in the comments below. Not just your opinion, your actual framework for thinking about this. And if this breakdown added clarity to your thinking, do one thing right now: share this video. Not for us, but for someone in your circle who is trying to understand what is happening in these markets and getting confused by contradictory headlines. Hit the share button and send this to one person who needs to see it. That is how this community grows. And if you are not subscribed yet, do it now and turn on the bell so you are here when we cover next week's PPI and Beige book in real time.